When you talk about that overall thematic, I'm thinking about the conversation that we just had in terms of how you break down the different parts of EM. Because basically you told me that when people think about emerging markets, a lot of people think in a global term, emerging markets. But within emerging markets, actually, there's a lot of differentiation and people should be thinking in those terms.
Yeah, I think that's a great place to start. And let me step back a little bit, take us back to the late 90s. And get us to where we are now, and think prospectively as well. EM used to be a beta to global growth trade in a sense, right? If you thought that global conditions were very supportive, growth was robust, then EM was a great investment opportunity. It was kind of boom and bust in that sense, right? And that type of strategy worked really well. And if we think about the genesis of EM as an asset class over the last, say, 20, 25 years, the late 90s was really an important time. We were getting out of successive crises, right, in the 90s, tequila crisis amongst them. We saw institutionalization of some financial sector reforms, which included opening up of these economies to the rest of the world. That was really important. It led to a rash of inflows into these economies. And this was also happening at a time when we saw the accession of China to the WTO, and as well successive monetary policy easing, particularly by the Fed over the 2000s. So from the late 90s till mid-2000s was a really good time for EMs. You saw a rise of commodity prices as a result of China's incessant demand for commodities and other imported intermediate goods. That was very beneficial for EMs as they opened up. So it was a virtuous cycle that was manifesting in the late 90s, early 2000s for EM, and that was the kind of golden time for EMs.
And as you say that, I'm sensing a button's coming here or something.
Oh yeah, a big one, a big one. That all changed in early 2010s. You saw essentially a slowing down of China, right? It shifted more towards a consumption orientation rather than the fixed asset investment orientation. Growth began to slow in China, in part as a result of that. But you also saw an erosion in competitiveness for EMs. And we'll talk about this a lot during our talk. I mean, one of the main indicators that I look at for EMs is the real effective, real trade-weighted exchange rate. That's a really good indication of course, it's a measure of relative price, but for me, it's an indication of underlying competitiveness. And the big problem for EMs is that they lack competitiveness. That's the real issue. And so going back to the 90s, 2000s, what you saw was easy to grow, right? You didn't have to do much. This was a perfect opportunity for EMs to institute, deep structural reforms, get them on a much stronger growth footing for the future. They didn't really need to do that, right? And so now they're in a position where their competitiveness is challenged, right? They're struggling for growth now, less reliant on these prior sources of growth like China demand and things like that. So they're struggling, right? EMs in general are struggling for growth. If you look at it, the forecast for EM growth this year is around 4%. That's deceptive, right? If you take India, China out, let's say, to the bigger EMs, EM in general is growing around 2%. That's not much more than developed markets, right? Some in the market are calling it the secular stagnation of EMs, and that's, I think, appropriate to consider that if you look at growth in particular. EMs are and have been relatively challenged, and I think that's an issue that's going to persist in the coming years.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.